The Financial Survival Network, helping you to survive and thrive in the new economy. To find out where to buy gold and silver reliably at great prices, go get your free Financial Survival Toolkit at financialsurvivalnetwork.com. You'll also get our complimentary newsletter. This is the Financial Survival Network.
1490 WGCH. This is Kerry Lutz, and you're listening to the Financial Survival Network, which is brought to you by Miles Franklin. They've been in business selling gold and silver for over 20 years, and I'm a customer because when you buy, they ship. For more information, find them on the web at milesfranklin.com or give them a call at 800-822-8080 and get a free quote. You're looking for security. I'm looking for security. That's why we look to precious metals. But in our insatiable quest for the ultimate security, you can't let market conditions and emotions get in your way of understanding the exact role of the metals and the stocks. That's why Bob Hoye is on. He's back with us. You know him. He's a friend of the show. He's been studying cycles since he was in diapers almost, and he gets it. Hey, Bob, welcome back to the Financial Survival Network.
Good to be with you, Kerry. And we are in exciting times, but volatile times. I think the difference between one and the other is that it's exciting if you get the trades right, and if you don't get them right, it's nasty, volatile things. Or if on the supply-demand side, gold bugs or silver bugs, when their forecasts don't work out, it's immediately a conspiracy theory where the powers that be are driving the price down, or they lapse into the notion that they've got the perfect study on supply-demand on gold or silver, and then when it doesn't work out, they blame, it's the paper market, and the guys in the futures don't know what they're doing. So, but at any rate, we've been able to weed that all out by taking a look at gold's real price. And going back in history, 300 years, and you stay in the world's reserve currency, which is now U.S. dollars. It used to be sterling. And you used to be able to determine the real price by deflating it by the CPI, when Consumer Price Index was a reliable calculation. But ever since Bill Clinton, the CPI calculation has been, let's say, suspect. But then it's more fun. We then said, well, let's just do it against a commodity price index. And we wanted to have a commodity price index that didn't have gold in it because you're comparing it to gold. The Economist All Items is that way. Most other popular indexes are not. So then we just said, well, we'll create our own. Hopefully it's like the Economist Index, and it has been. So this tells a story that in good times, like you're on a business cycle expansion, stocks are going up, the economy's going up, and commodity prices will be going up, and they'll be going up faster than gold does. That's the way it's worked out. And then you get in a recession, and then commodity prices go down, and but they usually fall in a recession relative to gold. So if you just take a look at crude oil, and as it goes up, that represents energy costs. So any mine will have either electrical or coal-fired or oil-fired, and then they also the cost of blasting agents. All that sort of stuff is all related to cost of energy, oil. So what you look for, the best times actually for gold mining in history has always been in a post-bubble deflation, whether it was after the bubble of 1825 or after the bubble of 1873 or 1929. The conditions for gold improved terrifically in a post-bubble deflation, and that's where we are now. Kind of like when you talk to Orthodox people, point out that when you're at the end of a bubble, such as 2007, the world gets really different. Usually the stock market leads the economy, where you have a stock market high, like in 2000, the bubble top in March. then the recession didn't start until a year later, so there was sort of a 10 to 12 months lead. But when you're at the end of a great financial mania, the turn down in the stock market is virtually with the turn down in the economy. Like 1929, the stock market peaked in September, and that business cycle peaked in August. The previous bubble, 1873, the stock market in the U.S. peaked in, and the recession was seen to start in that October. Then in 2007, the stock market peaked in October, and then the business cycle was determined to turn down in that December. So the start of it is distinctive, and then you have a severe recession, and even the orthodox side of economics has been saying, they call it the Great Recession. And then the other part is that each of the business expansions are very weak. So strong recessions, weak expansion, and our case has been is that a global recession has probably started like a few months ago, and it'll spread around the world, including the U.S. So then now what that does is drive commodity prices down relative to gold. And this is showing up our index, gold divided by commodity indexes. It had a low earlier in the year at about 419, and now it's up to 460, so there has been some improvement.
And the last time we talked, you said this was going to happen. We talked, I guess, about 2.5 months ago. It was our first encounter. And you said that commodity prices relative to gold would go down. At that point, oil was trading $100 a barrel plus. Now WTI's at 85, and we've seen copper come down, a lot of the base metals, silver a little bit, but not too much because it's starting to trade, I guess, in alignment with gold. We always like to think, you always like to think, I do, that we're different. We're smarter than those bumpkins were in 1929, and it's not going to happen to me. I'm not going to let this, you're not going to do this to me. And yet, Bob, we're back in the same place where we always wind up, aren't we?
Yeah. Well, it was 7 or 8 years ago when Bernanke, they were having a commemorative or birthday for Milton Friedman, and he said he sort of made this boast that we promised that we wouldn't be as stupid as the Federal Reserve was in 1929. And then bang, that same thing, the same bubble. And the establishment now goes around saying that it with all its stimulus that they came in 2007 and 2008, they prevented things from getting worse than they were. But if you take a look at the Dow Jones, the percent decline was virtually the same as in the first crash in 1929. It just stretched out over a couple of years instead of one fall. So they really didn't change things. And how can one protect one's money? And then, two, how can one make some money out of it? And the first of all thing is protect yourself. You've got to stop listening to orthodox brokers and orthodox economists and central bankers, because these guys haven't got a clue what's going on. And then you have to trade your account when it's overbought and when it's oversold. Trade the swings. This was our view on the golds and silver stocks last year, because in that rally to March, April, where silver was soaring relative to gold, and in any bull market for gold and silver will always outperform. But the real trick that silver provides is that once it starts to underperform, they can both be going up in the final week or so, but once silver starts to lag behind gold, that's usually 2 weeks before the high, and that also happened in July or in January of 1980. I was in the business then, but I didn't know that trick.
You learned the hard way. You learned the hard way.
Okay, so then the other one is that you keep track of the gold-silver ratio, or let's put it this way, because you're in a bull market, the silver-gold ratio. So the RSI on the silver-gold ratio, as it rallied up to March, April a year ago, got up at over 90, and that is huge. Checking back on it, the only time it ever got that high before was in that fateful month of January 1980, at that high. So we knew that we had a big high for silver clock, and that it would take some time to get rid of that excess. So, but you didn't have as big a percent rise or a momentum rise out of the gold stocks. But here's the way it ended up looking back at the wreckage, because our view was that you had that important high for silver, it would take some time to work it off, and that the gold stocks, you should trade the swings from overbought to oversold. And then we came down here. So what happened is that we figured that out of the problems in the stock market last October, we figured there'd be a recovery out to around February, which more or less worked out. So then the idea was to take money off the table across the board in February, and that included gold stocks. But we didn't know that they would get hit so hard. So then they got hit hard, and that's where we got into some of our long-term stuff, where we've got the XAU index, historically ideal, it goes back to 1983. Then some time ago, we managed to get the daily trading record for Homestake and had that as a proxy for the gold sector, back to 1900. So then when you, on that excessive decline in March, April, we did the monthly RSI on it. And then in the middle of May, that RSI got down to 24. And I'm just using round numbers, Kerry. And that then was the second worst sell-off in history. The worst being a 22 RSI in 1924. Now then there were three other bad ones that were sort of in the 25 and 26 RSI. That was in 1942, 1948, and then in 2008. So there have only been 5 oversolds that we would classify as severe, and the one that it culminated last month was the second worst in history. So the other trick that we pointed out, this was in the middle of May when I was at one of the speakers at the Committee for Monetary Research and Education spring dinner, is pointed out that monthly had registered, and that in the previous examples, the turn-up in gold stocks was virtually immediate, which we got. So
yeah, exactly what happened.
As we like to say, so far so good. So what we're looking for is, let's call it a new bull market for the gold shares. One little clinical, technical trick we'd like to see is a good correction in them, which they seem to be getting now. And then clinically you can say, and when they get the test and then move up and the next leg up. But intuitively and historically, I'm saying that this is more than likely a new bull market for gold stocks, in which case one would buy the dips rather than last year, which was to trade the swings. So.
And what's great about buying gold stocks now is that the quality stocks, producers or near producers, have been so beat up and they're trading at tremendous discounts to the assets in the ground that, assuming that you're right and that the bear is over, those things will just explode on the upside. I mean, every mining company with cash is looking for acquisitions right now.
Well, there was one announced a couple of days ago. I can't forget Yamana or something. Yeah, and I thought, ooh, this is interesting, because they picked off one that had dropped hugely in price. Now, again, historically, let's look, and we look at the Homestake in 1929, the stock crashed down to into low 8 and 1/8 or something, I recall. But the price of gold was fixed at $20.67 an ounce. But during the 1928-29 boom, the cost of mining went up, the energy cost, wage costs of miners went up because the copper and base metal side were doing very well. And then came the crash, and the energy costs came down, and wages came down, miners became available. So then what the trick is, you want to take and look at Homestake up until the end of 1932, when the price of gold was still fixed at $20.67 an ounce. but their earnings had improved by something like 130%, and the stock was up about that much in the end of 32 when the general stock market had suffered the whole crash. So this is where it's important to look at the real price rather than the nominal price in dollar terms. It's fine if you're going to trade gold in dollar terms, follow it, but an investor who is serious about the stock side will always watch for the real price. So anyways, then eventually when Roosevelt depreciated the dollar relative to gold and moved the dollar up to 35, that, of course, he was amplifying what Mother Nature was doing in every post-bubble contraction. She raises the price of gold. So then Homestake in the 30s later on in the 30s, 38, 39, got up to about $65. But Homestake could have been bought in 1930 and into 31 for $9 a share.
Wow.
And then it gets to 65. But here's even more on top of that, Kerry, was that it was paying $4.50 a share dividend on a $9 purchase. I mean, that's
not much risk there, huh?
So it's interesting that in the last year that some of the seniors have begun to concentrate on a dividend policy. I doubt that the industry will ever go back, because essentially gold miners then, whether it was Homestake in the U.S. or Dome Mines in Canada, they virtually paid out everything by way of dividends, so they weren't looking for growth. Whereas this time around, I think the gold miners will be focusing on growth, and so then those charts were available decades ago, and in the early 70s, which begin to reveal just how ancient I am. I went to a promotion with a big Canadian promoter, had some story. I don't remember what the story was, but the interesting thing is he had an older guy then, who very dapper, double-breasted suit, who was the warm-up guy for the great promoter, telling everybody how wonderful it was. So then after the presentation, I took this older guy aside, and I said, look, you must have been in the business in the early 30s. And he says, yeah, Sonny, I was. I said, were you in the junior mines then? And he said, yeah, because I said, I've got a chart on the seniors like Homestake, and they did very well in the 30s. What I was wondering is how well did the juniors do? And he said, Sonny, I was in Montreal, which was the speculative exchange in Canada then. And he said, in 1933, he says, my biggest account bought me a brand new Ford Roadster. That's a gratuity. So were the promoters making money in the early 30s in junior gold stocks? Huge money. And it'll happen again.
Yeah, no doubt. But we do have a lot of fear in the market, Bob, of collapses, of economic disruptions, of civil unrest. I mean, how real is that?
Very real. One of the pieces that we did years ago, we call it Sovereign Debt Folly. And through the big bubble in 1873, London was the financial center, and sure, the big action was in the stock market, but also there was outstanding action in the expansion of credit, underwriting debt, and there was the urge by income investors to grab yield and reach for yield, and so they were underwriting all kinds of small countries and companies and all that sort of stuff, and including lending money to Spain. And then you had these headlines in the Economist about, they get worried about, maybe you're into a year after the bubble top in 1873, and they're getting worried about whether Spain would be able to reach its coupon and pay it. So then the Economist write, yeah, it looks like Spain will meet its interest obligations, and then, oops, they didn't make it. And then eventually it ground on for a year or so, and then eventually it was Spain defaults and riots in the streets.
Wow. Sounds like today. Sounds like a paper from today.
And then that was the disaster in the early 1870s. And then you had a brokerage firm, perhaps a bond underwriter in New York in 1932 or 33, reviews then the disaster in sovereign debt in the early 30s and mentions that the problem in the 1870s and said, no one ever learns. And the excitement in 1929, people were investors, fixed income investors, were reaching for yield and buying all sorts of dreadful paper. And here it is happening again. But one of the evils that is really going on now in the credit markets is that the policymakers, whether they're advising central banks or the central bankers themselves, all have this strong belief that they can throw credit at a credit contraction and it'll go away. But what they're doing is gambling with taxpayers' money, the taxpayers in the countries that are still not yet seen to be in default. And it's evil what these guys are doing, and it's the outcome will be very nasty. And I believe that the central bankers and policymakers will suffer the same loss of esteem that happened in the communist countries after '89 when the Berlin Wall came down, and effectively communism, socialism was seen to be a failure. And in which case, in the Western world, in the freer economies, it will be that the mixed economy of a command central bank and a free market, half and half, that experiment will come to an end, and the public can figure it out. I have a lot of confidence that the public will figure it out, and when they have to tighten their belt, they're going to take a look at their municipality and no more extravagance there. They're going to look at the state level, no more extravagance there, and the federal level. So a lot of this is going to be a grinder, but for me, it's a very exciting time.
I'm totally in agreement with you, because if we weren't living in these exciting times now, I wouldn't be doing this. I'd be a lawyer doing boring stuff. I mean, I was never cut out for a 9-to-5 office job. Yeah. And that's why I got into this. But, it's remarkable because they don't teach this history, Bob, anymore. I've acquired it over the years. There was a series of books written about the Great Depression and the 20s, 30s, and 40s. I can't remember the guy's name. He worked for the Times, and he talked extensively about the Depression, the ABC agencies, all these people put to work, and yet Morgenthau, who was the Secretary of Treasury in 39, said, we've never spent more money, taken on more debt, and yet the unemployment rate is exactly what it was when FDR came in. And, you watch this because obviously you've studied history more than I have, but I've studied enough to know that we're not as smart as we think. And certainly when it comes to economics, we can't create new laws that you can live by that are going to repeal the business cycle, the credit cycle, and all that stuff. All we could try to do really is to put in a system that accepts those realities and kind of plans for the eventualities. But yet we start to get this omnipotence, as the human race is apt to do, that somehow this time is really different. And, that's like, I'm on my third marriage now. And you know what? I'm starting to doubt the wisdom of those words.
Well, Kerry, just in closing here, the public who will become highly offended as this recession comes in,
as they should
and they'll be looking at the huge stimulus that was spending their tax dollars. They're going to be saying no to it. But the other thing is they're going to look at the nonsense of managing the interest rates and the concept of managing the purchasing power of the dollar for all kinds of ideas. They're going to say no to that as well, and the public will insist on a gold standard.
I hope you're right.
It'll be very exciting times.
I so hope you're right, because it really, look, gold standard gets cheated on, and it's been abused throughout history. We know that. There's no question. But that needs to come with debt reform. No sovereign debt, no matter what. I don't care about emergencies or anything. There is never a justification for a country to go into hock, because you know and I know all sovereigns eventually default on their debt, and the creditors and the public be damned. And the two have to go hand in hand here. There's no one without the other. But I think this blow up will be so big that these lessons will be tattooed on everyone's gray matter for time immemorial, because this is the event probably of the millennium, the dollar blowing up and the world financial system blowing up. There's no question in my mind that this is a millennial event. And
I think so.
Yeah. So
it's going to be exciting.
Yep. And it'll be a lot more exciting if you've protected at least a portion of your wealth so you're able to get through it. But that's an individual decision that everybody has to make, which is why I keep bringing on different people who more or less say the same thing in different terms. Bob, people want to learn more about you. If they want to get in touch and learn about what you're doing, where should they go? Well,
you can look it up in internet as institutionaladvisors.com. Or actually, an easier way is just straight my name, Bobhoye, and that gets you into a lot of the stuff that we publish, and it also gets you into our website. So,
excellent.
Thanks a lot.
Hey, always a pleasure, Bob. You be well.
Okay.